I'm Sam Slator from Chelsea, and I'm here today with Nick Martin, manager of Polar Capital Global Insurance Fund. Hi, Nick.
Hi, nice to see you.
What type of insurance companies do you invest in?
We spent now 20 years or so with the running the fund, and the predominant focus has always been throughout those 2 decades on the non-life or property casualty insurance sector. We can invest within the life insurers, but we choose not to do that. So we do have that non-life focus, but that really spans a whole spectrum between sort of personal lines in terms of people's car insurance, home insurance, but for us more importantly commercial lines. So that's the business that's bought by the corporates themselves, whether that's protecting factories, their people, employees, product liabilities, a whole spectrum of insurance. So a lot more than just meerkats.
And why should an investor think about putting money into the insurance sector?
Yeah, a fantastic question. In some ways, if you just looked at the aggregate returns of the insurance industry overall, and I include within that not just non-life property casualty but life insurance as well, you'd probably look at those returns and think, I don't really want any of that. Thank you very much, because actually in the aggregate it's a very mediocre industry at best. But what's particularly interesting about insurance is one where the dispersion between the good and bad is huge. And that lends itself very nicely to stock picking. I would say that to some degree you would say, but I think if you looked at something like an industry ETF, I think the returns would be very challenging over any long-term time horizon. So the other thing to remember is that insurance is an incredibly valuable part of the sort of the workings of any economy. Ships don't sail, planes don't fly, nothing. Your Amazon parcel doesn't get delivered without insurance being there. And it really sort of it's the oil that greases world trade. And if you look at it in terms of what it does, I mean, most insurance is not a nice to have product. It's a compulsory purchase in a lot of situations. Think of your own car and home insurance. Businesses, management teams would be they wouldn't last very long if they didn't properly insure their own employees or factories and assets and everything else. So there's a real resilience in terms of insurance demand, and I think for investors' portfolios who want some diversification against some choppy waters in financial markets, if history is any guide, insurance and our fund has been a pretty good place to be.
Most of your stocks are based in the US. Why is that? Is it that because there's more of a litigation culture out there?
No, I wouldn't say that necessarily, but that certainly is probably true. What we tend to find over the years is the best underwritten businesses tend to be in the US. So our focus in the fund is more on the small to mid-sized companies rather than the big conglomerates. So typically in Europe you find some of the big multinational, multi-class companies where we try and find specialist businesses. So in the US, there's plenty of those to have, and they also think about per share value creation in the way that they run their businesses, rather than what you often see in many other markets is people trying to actually build empires and plant flags. And the final thing I would say is the disclosure in the US is always very good, particularly around reserving, and that's a very important part of assessing any insurance company, is looking at the adequacy of reserves, and the disclosure in the US, not only from a stock market point of view but also regulatory, really is helpful to our investment process there.
We hear a lot from other asset managers about the growing middle classes in Asia and how that could be a benefit for insurance companies with more people taking out insurance. Are you finding that as well?
Yeah, I mean, the case for growth in Asia is indisputable. You see the population statistics. As people come into the towns, and they have urbanisation, which is causing significant increase in demand in insurance. So the growth opportunity is certainly there. The thing that we find a little bit more challenging is can you really find profitable growth? And I think that's always been an important part of our process, is finding companies where the majority of their earnings come from underwriting, so taking more in premiums than paying out in claims, and having relatively low risk in terms of their investment returns. The trouble you sometimes find it in Asia is that underwriting margins are very skinny, in some cases non-existent. So therefore, a company's earnings are largely dependent on what they do in investment markets. Now, I'm not a macro hedge fund manager guy. I'm a dull and boring insurance person. So I don't think we really have any edge when it comes to looking at some of those companies. So for us, it is very interesting. We look very hard, but probably less than 5% of our portfolio is invested in the region, which is significantly below what you might expect.
2018 was a year of a lot of extreme weather events, from floods to earthquakes to extreme heat, etc. How does that impact on the insurance sector?
Yeah, I mean, it obviously has a huge impact. As you say, the last sort of year or two have been very active in all kinds of situations, and people see every day, changing weather. It always seems to be the unusual period of whatever you want to talk about, whether it's heat or rain or whatever. And obviously, the insurance industry gets impacted by that. One thing I would say, whenever bad things happen in the world, it's always a great time for insurance companies to demonstrate to the buyers of the product that actually they provide a very, very good service, and they try and make you whole after these bad things happen. When we think about particular events, the first question that's often not asked, and it should be, is how much of that particular event is actually insured. Sadly, probably about 30% of the losses that we have for most of these hurricanes or earthquakes or flooding is the bills picked up by the insurance industry, and the other 70% is largely uninsured, and that's a fantastic growth opportunity longer term for the industry. But that's one thing we always want to think about. And even in some of the developed markets, you would think insurance would be very highly bought. But in places like California, probably 10% of households buy earthquake insurance. We've seen in the last couple of years, particularly with Hurricane Harvey of last year, that was a big flooding loss. This was a huge storm that was very, very slowly moving. So there wasn't much wind damage being caused by that, but it did lead to a lot of flooding. And in the US, flooding is largely either not bought, or when it is, it's provided by a government-backed entity. So the insurance industry didn't pick up much residential flooding losses from that. So whenever we look at these events, we have to be very mindful about how exactly they impact. And it's very hard to make sort of generalizations about how the industry gets impacted.
And are new sub-industries evolving, like cybersecurity, data security?
Yeah, to some degree. I think it's been very interesting watching the emergence of cyber over the last few years. I mean, if you look at many corporate surveys, cyber risk would be one of the main risks that company management teams identify, and it's one where the insurance industry, is relatively challenged in order to be able to satisfy, which is obviously probably quite a high demand. And if you look globally, there's about $4 billion worth of cyber insurance premiums. And to put that in context, we're talking about a $2 trillion industry, so very small in the overall scheme of things. And you have to think about insurance a lot of the time is based off of in terms of pricing past claims history and loss experience. Well, that's quite challenging in a market such as cyber, which is relatively new. So I think the industry, quite rightly, has been quite cautious in how it's offered this product. Rating agencies and regulators have been appropriately nervous about that as well. But I think it's a great industry opportunity to really change its thinking somewhat, because up till now the industry's proven great at insuring sort of atoms, factories and things and stuff, but it's been less successful in terms of addressing customer needs in terms of insuring atoms. And we have to think about that, or insuring bits. I have to think about that going forward.
Thank you very much. That was really interesting. Thank you.
Thanks very much.
If you want to learn more about Polar Capital Global Insurance, please go to chelseafs.co.uk.